Volatility is a function of available liquidity. This is a quote I got from famous trader Chris Lowry. And looking at your chart, it's clear that price will always push to the less liquid side of the market. And I'm sure SMC traders, these are concepts you're also familiar with. And in today's video, Forex price action traders, I'll be taking you through the EURUSD chart. This is actually the current live chart. I'll be taking you through the concept of liquidity void, the concepts of a price run, the anatomy of a price swing, and basically why I have the two trade ideas on my chart. So let's deep dive. What you see on your chart, traders, is the H4 euro dollar chart, and you can see I've split it into two, the box highlighted red and the box that is highlighted green, and these will form the core concepts of what I want to talk about today. If you look at the box that has been highlighted red, you see there are certain characteristics. You will see there's a top here where we saw there was a bit of price efficiency in the market. That's what you ideally call relative volume stability. And I want you to look at this candle. What did it do? Clearly broke below that level. Just let me zoom in into that level. You can see it well. Look at that candle. Clearly broke that level. And now you look at the following candles following this break. As you can see, we did not see a retracement to that breakout area. We did see a continuation of this down move. The order flow was heavily bearish, cleared this level on the daily chart, did not even spend some time here and continued on its way down. Ideally, such moves leave liquidity voids and creates what is called price inefficiencies. And characteristics of such a price inefficient move, ideally you will see large bodied candles closing towards the ends. As you can see, the wicks are almost non-existent, quite small wicks, and you ideally from the broker side you'll see increased spreads, basically widening spreads. And it's because the broker has to protect themselves, because the environment they're actually in right now could compromise their ability to find counter trades. So it's basically just an algorithm by the brokers to protect themselves once you see widening spreads following such moves. And the body is actually a representation of the current liquidity state. And what usually happens to drive such a move is you'd see there's a level in the market where there's fairly relative volume stability. Then a large order will ideally come into the market, and large orders or such substantial flows are usually not pushed into the market at once. So ideally it will be pushed into bits. And if it's pushed into the market, given it's a large order, remember at this point you have fairly volume stability, then a large order comes in. So it means this large order is coming to a market and it will find weak offers. So there will not be offers to match that particular order. So ideally you'll see a price run and price will move, be inefficient as it seeks liquidity. And this is what actually drives such moves in the market. Ideally, price will face exhaustion, as you can see, and it will start retracing. And ideally, it will usually retrace to the breakout area, as Chris Lowry actually calls it, a point of release, POR, around that level. Basically, where you see where there's relative volume stability over here, basically where that candle broke, around that level. So ideally, you'd see retracements to that level. Not always, but most of these moves, you'd see retracement to some of that breakout area. If you look at your green shaded area, this is now the retracement to that particular breakout level. You'll ideally see a mix of candles. As you can see, we have a lot of bull and bear bars, the bulls being the white candles and the bears being the black candles. It's a mix of candles. They're actually more, you ideally expect more candles than these down move. Yeah, as you can see in the down move, we have 19 bars. And as of today, given the start of the retracement, we have 118 bars. So you have 19 down move bars completely engulfing 118 bars. That shows you that the market is heavily to the downside. If you see such a price chart from a technical point of view, of course there are a lot of factors that drive markets, including fundamentals, but this is just to give you the basics of what happens from the aggregator side and the broker side, and what actually causes such moves and why they form part of good trades that we see online. People posting, of course, on their YouTube pages and all that. As you can see right now, we are retracing, and I would like to take you through this same price action as seen on the daily chart, so that you can see it's not all about the pricing, it's all about also previous price action that drives such trade ideas. As you can see on the daily, we had what you can call a head and shoulders pattern, with this idea being the left shoulder. This region here where we saw a false break, and I think I talked about this in one of my videos, we see the head, and here we see the right shoulder. It did break out, but this breakout did not meet the prerequisites of a valid break. As you can see where the breakout started here, did not even linger around this level, because ideally you'd expect to see a bit of push and shove around this level before we break out, but it did not. And you can see we did retrace. Of course, the market expectation is that this level will hold. The level I'm talking about is the support area around 107.20. It did not hold despite the push and shove that we saw here. Bears did try their best to go down, but the bulls were just adamant. And also driving this move was the fundamentals. Remember, we had the NFP and the Fed. Yeah, the FOMC statement that came out, and you can see price has been bullish since. I did take a trade, which is what you see here on the H4. As you can see, I have 2 trades in, and going back to the daily just to explain my rationale of taking the bull trade despite these heavily bearish order flow. As you can see, this price was highly inefficient, so I expected a retracement, and once price closed above this level, despite the long week, this was my confirmation to actually go long, because my expectation was if we're really bearish, this level would hold as new resistance and we would see a continuation. We failed to see a continuation, and the news supported for a weaker dollar, and that's what we saw, a price close above that level. So as previously stated in my other videos, once price breaks a level, you need to mark it and expect price to actually retrace to that level. Use it as a point of reference. Once price breaks a level, always use it as a point of reference. And my entry was just right where these wicks are. I expected price to retrace to where these wicks are, and I expected to see a bullish reaction. And my target is the point of release that you see highlighted with your blue line over here. As you can see, price is fractal. What you're seeing on the daily is basically the breakdown that I've showed you on the H4. On the H4, zooming in into that level, as you can see, it was a series of wicks and bodies around there. So I expected price to at least retrace to that level and react, and that's exactly what we are seeing. In my risk management, I risked 2%. And in this 2%, I usually take 2 trades. The first trade, I risk 1%, and I target 1:1. As you can see, my 1:1 was already hit. Just from a visual point of view, you can see 1:1 is already hit. So I already secured 1%. And as of the recording of this video, I've already moved my stop loss to break even for the remaining 1% trade, which I usually target now the point of release. So for this particular trade, you see I have 2 trades in. The first one already closed at 1:1, and the second one 1% still running, targeting the point of release. So total R, if I win on this trade, will be the 1% that I've already secured, and the 2.7% which I'll secure once we hit TP. That is, if we hit TP. If we don't hit TP, I'll close out at 1%, given this trade is already at break even. I've decided to take a second trade. And this one, if you to just zoom in into the microstructure of this move, we did see price retrace to this level, as I showed you. It is a key level observed on the daily chart, and I did love the reaction that I saw. Ideally, I love taking retracement trades, and given this heavily bullish move, I expect price to retrace to previously broken level. As I said, use your previously broken level as points of reference, of course, trading in the direction of the higher time frame. So I'm expecting price to retrace to this level, and I'll take a long trade, of course, targeting the same point of release. And I'll trade it in the same manner, take 2 trades. One trade, my take profit will be 1:1, and the other trade, 1%, I'll target the point of release coming in around 1.0850. And that, ladies and gentlemen, is basically how you trade some of these price inefficiencies in the market, of course guided by your higher time frame view and previous price action. It makes for good trades. It may not necessarily have a high win rate like 80%, but if it wins 70% of the time or 60% of the time, and with proper risk management, you'll be profitable. compared to most traders. And with that, I come to the end of the video, and I hope it has been useful to you. If you want to learn more about price inefficiency, liquidity voids, and basically how these liquidity and price you see in the market originates, you can go to Pro Traders Club. Chris Laurie, this is where he actually learned this. He has a free learning section, where you don't pay anything, but he has a nice series on price run basics and liquidity basics. You'll be able to see how the price you see in the market is determined by banks and all these players in the market. With that, I wish you a profitable week and good week ahead. Thank you. Enjoy your weekend too.